discuss SARS Draft Interpretation Note on the application of Section 7C. First of all, welcome to the guys from my office and also to the guys joining online. My name is Unicus. I studied a bit of tax, and these sessions I do because I need to keep all of you guys in my boardroom up to date. Right, that's the main reason why we do this. And we said, well, since we're doing it anyway, I might just as well put a camera on and get other people who don't have the benefit of joining us as well. It is, however, predominantly aimed at you guys because I work with you and I get to see the stuff that you deliver. So for those of you joining online, please bear in mind that this is mainly aimed at my staff, but there's no reason you can't join for interest's sake. All right, so Section 7C, before I get going, Kirsten from marketing, is everything working? Yeah. All right, so 7C, this is a draft note issued by SARS on Section 7C, and I think most of you, at least those of you joining, and I know everybody in the office, knows about Section 7C, right? But what is important is to understand the context and background behind Section 7C, because I often see people, they see a trust and a loan and they go, 7C must apply, right? And I understand the reason for that, and that's probably a more conservative approach, which is not wrong. But what is important to understand is when you interpret tax legislation, or any legislation for that matter, it's important that we understand the context and purpose, because that's what the court said in Domeni, how we must interpret legislation, in context and for purpose, right? And that's why, by the way, we read things like explanatory memoranda, right? And we read things like draft interpretation notes, and we read things like response documents, and draft legislation and amendments, etc. You have to look at the context and purpose, and to do that you need to look at things like explanatory memoranda. You need to look at the Davis Commission of Inquiry's findings, because that's where all of this comes from. And that gives you, before you even read the section and the nitty-gritty of the section, you understand what it is you are looking at and what the purpose of the section is, because that drives the way you interpret it. Right, so the background behind this thing, it's aimed to curb estate duty avoidance by the use of loans. Right? And let me put it in context how this used to work, right? If you have an estate with a value of, call it 100 million rand, right? You could move this 100 million rand, right, to a trust, and you would pick up the CGT on the sale, but you would anyway if you die, right? And then you'd pick up estate duty if you die with the thing in your estate. So what people used to do is they would transfer the asset to the estate on loan account. And all that does is it caps the value of the estate because the loan is interest free. So now you've got a 100 million rand asset that is not going to appreciate in value because it's interest-free, and all the appreciation in value is going to sit in the trust, right? And all that appreciation in value is going to dodge or avoid, if you will, estate duty. And that's what people used to do. So what Section 7C does is it is aimed at curbing that sort of avoidance, right? Just want to keep on muting people as they join. Sorry, guys, can I please ask that you mute yourself? And so what the section effectively says, it says, okay, fine. What I'm going to do is in my 100 million rand example, right? I'm effectively going to deem that asset or that loan of 100 million rand to appreciate in value by the official rate of interest every year, and I'm going to make you pay state duty in advance. We call it donations tax. That's the purpose of Section 7C. Does that make sense? So what you must bear in mind whenever you interpret Section 7C and look at it, you need to consider what is its purpose, because not all loans to trusts or loans between companies owned by trusts necessarily avoids estate duty, right? And that is crucial because people look at loans, and I'll do an example right at the end to show you what is a typical example of where people tend to think Section 7C applies. The basic premise of Section 7C, which by now you know, and by the way, this is a draft note issued by SARS, and just by the way, what is the status of SARS's interpretation notes? Who's writing the article for me on this draft interpretation note 142? Mika, it's you and Paul, no? So, what is the status of SARS's interpretation notes? This is just a draft, by the way, the one that I'm discussing here, but really it doesn't create any form of precedent. It's not legally binding. Yes, it creates potentially a practice generally prevailing, and I say potentially because when you look at the Marshall case, it's not necessarily, especially if they just unilaterally issue one. This is a draft which they sent out for comment, whereas the one on 142, have you guys checked? There was no draft. There was no draft. All right. For those of you interested in doing listening to my discussion on interpretation of 142, it's on the Unicus YouTube channel, I think. All right, so We look at the note nevertheless because it's a refresher of 7C and it gives us an insight as to what SARS's interpretation at least is, which doesn't make it law, by the way, despite what they might think. All right. So it treats effectively the difference between the official rate of interest and the rate of interest that you charge. It deems that a donation at the end of the year, right? That's effectively what it is. Remember what I said is it's because what effectively the section does, it says that estate value that you've tried to cap at 100 million in my example is deemed to appreciate in value by the official rate. And so I've looked at this before, and I'm not saying this is necessarily what you must do, but if you consider, everybody thinks Section 7C is just now everything, nothing works. If you reckon you've got an asset that grows at a rate faster than the official rate, then you might very well still be achieving the goal that you wanted to achieve, although the official rate is quite high. I'd like to see the investment that yields higher than the official rate of interest. There are not as many, and one has to take into account the CGT and all those sorts of things. But anyway, that's the point. It kind of makes you prepay the estate duty by way of donations. So what I wanted to do is I just wanted to break the section down to its basic principles, because again, like I said, people tend to look at 7C or loans to trusts and go, if there's a loan and there's a trust, everyone wants to run to 7C, right? It's a good thing to consider, but let's just carefully unpack what goes into 7C. So the first thing you must do is identify, is there a loan by a natural person, right? Or a loan by a company at the instance of a natural person to someone. So there must be a loan by a natural person, step one, or it can be by a company to someone, but then it must be at the instance of a natural person. The crisp issue being there must be some natural person, because who pays estate duty? Natural persons pay estate duty, right? So we said there must be a loan by a natural person, or at the instance of a natural person, a loan by a company. That is the starting point, right? To who? So that's how it must look like. You must first see, is there a natural person who made a loan? Or is it the company who made a loan? If that company is the one who made the loan, it must be at the instance of a natural person, and a particular natural person at that as well, right? So what does at the instance of a natural person mean? Well, it means at the request or at the influence of the natural person. But then that natural person, if the loan is made by a company, and you want to check if Section 7C applies, and we'll look at to whom those loans are, right? But it must be at the instance of a natural person then, and it must be a particular type of natural person. It must be a natural person who's connected to that company by virtue of paragraph D4 of the definition of connected person, right? Not any natural person, somebody who by virtue of paragraph D4 of the definition of connected person, at the instance of that person, the company makes a loan. And that is a very narrow definition of connected person in relation to companies. It says if you alone or together with any connected person, and you can help me, right, Mika, because you're looking at this, holds more than 20% of the equity shares, or at least 20%, I should say, of the equity shares. So it's not any person, at the instance of any person, it's the instance of that particular type of natural person. Then you could potentially fall into 7C. But then you must go and say, okay, fine, I have a natural person, or I have a company, and I have at the instance of a natural person who's connected to a company making the loan, and then that loan must be either to a trust or to a company that's owned by a trust, right? Then you could potentially fall into Section 7C. And I should pause here to say that, I don't know for those of you who've seen this, those of you online who've seen this, but I know that in practice we've seen it, because we've certainly seen a couple of these, is where SARS is clamping down on trusts, right? Because they're under pressure to collect, and they are sweeping and cleaning the bottom of the barrel everywhere where they go, right? And so they are definitely looking at trusts in particular, and what I found them to focus on towards middle of last year, are, by the way, distributions to beneficiaries, where they would ask for the resolution to distribute the income to the beneficiaries to get the lower tax rate, and then people come up with that resolution passed after February, and then SARS says, nope, that's too late. And that's right, by the way. There's unfortunately nothing you can do. If that vesting event did not occur before the end of the tax year, you're in trouble, right? The trust is going to have to pay the tax on it regardless. And then I always hear the story about the individuals will pay the tax. No, that's not the question. The question is, what's the law? All right. Anyway, so SARS is looking at trusts in particular, and I thought that's why it's good to cover 7C, because invariably, especially when you look at distributions to beneficiaries, which is what they're looking at, those things are typically left outstanding on loan account, and the question is, well, what about 7C in those instances? Because they are beneficiaries, they are connected. All right, so let's recap the gist of 7C. right? We need to have a loan by a natural person or some person who influenced the company that's connected to that company by virtue of paragraph D4 to make a loan to someone else. It must be to a trust or a company. So either the individual made a loan to a company or a trust, or a company made a loan to a company or a trust. All right? But in the case of the loan to a trust, there's a further requirement, right? If the person making the loan is a loan to the trust, then the person making the loan must be a connected person in relation to the trust, or a connected person in relation to the person making the loan to the trust must be a connected person in relation to the trust. Yes, I know that's a mouthful, and I'm not going to try and debate and give examples of that. SARS has got a whole interpretation note out on connected persons. And on trusts, it goes very wide, right? Who's connected to a trust goes very, very wide. So I'm not going to try and even go into that. That's a whole discussion in and of itself. I know myself and legal counsel at one stage had like a 4-hour discussion about whether two companies are connected to each other. So this is not something I'm going to try and cover. Know this, that there must be some connection. Because remember, the point is 7C is trying to curb estate duty. So you must have some form of influence, right, over this trust or over this company. And that you would typically have if you are connected to it or someone that's connected to you is connected to it, right? That's the way you would typically go about avoiding estate duty. So if it's a loan to a trust, there must be a connected person link. In the case of it's a loan to a company, then at least 20% of the shares in the company to whom the loan is advanced must be owned by a trust to which the lender or a connected person in relation to the lender is connected, right? Yes, that is again a mouthful, but there must be some form of connection between a natural person and this trust, right? That's the point, because otherwise you wouldn't be able to avoid estate duty and that would defeat the purpose. And if the loan then falls into 7C, go and calculate the difference between what the interest would have been in the official rate and what's charged, and you treat that as a deemed donation at the end of the year. You get your 100,000 Rand exemption if it's not used elsewhere, right? That's the basic gist of the section. Break it down because, again, you see a loan to a trust, you go, 7C, just go and see where's the loan. Is there a natural person here somewhere who's dodging estate duty? Whether on purpose or inadvertently so, it doesn't matter. Go and ask yourself the contextual and the purpose question, where's the estate duty being leaked here? If not, then you're going to probably find that the section, the facts don't fall into the section. If there is, you'll likely find the facts fit the section, right? Now, let's talk a little bit about what is a loan, because there's also some debate about this, and SARS has now issued this draft note, which gives us a little bit more explanation. And I think the most contentious one that is most common is the fact that loans includes any form of financial assistance, right? Now we know the practice and this flow-through principle in trusts that people will say, okay, the trust made X amount of million Rand, let's go and vest this in the beneficiaries because then we get the lower tax rate of the beneficiaries. Or there's a capital gain, we vest it in the beneficiary, so let's just vest it in the beneficiary. But those amounts are hardly ever paid out to the beneficiary, right? So you vest it, and if you don't pay it out, what happens to that item or that distribution? Where on the balance sheet does it go for accounting purposes? It goes in as a liability, right? Because you vested it in a beneficiary. It's not an accounting term, it's a legal concept. You, by virtue of exercising your discretion, in the case of a discretionary trust, you give that beneficiary that money, it's theirs, to do as they please with it. If you don't pay it to them, the question is, and that creates, if you will, a loan, right? Does that loan fall into 7C? And the answer is, well, if the beneficiary is elected for it not to be paid out, then yes. Or requests that it not be paid out. Because what's the beneficiary doing? He's effectively saying, it's my money, but you can use it for the general purpose of the trust. That's effectively creating a loan account, and that will squarely fall within Section 7C. And this has been the practice for years. I've seen on many trusts where people say, just vested in the beneficiary. And oftentimes the resolutions aren't there, so it's a disaster. There was a case I worked on, guys, recently, where I consulted for a large trust company on a transaction where what they did is they did the distributions, right, over the years, and they declared the trust as not having taxable income, and they vested in the beneficiaries. Turns out the resolutions were never passed, so that was just wrong, right? And no matter how smart you want to be with accounting, accounting does not determine tax consequences, the law does, right? So the question is, if you actually exercised the discretion and you vested it, sure. If you didn't, I don't care what your accounting says. So then SARS went in that case and said, I'm going to tax the trust on it. right, for all the last over 10 years, right, that you've made these distributions and you haven't paid them out. It's not 7C. That's not the point I want to make. I'm going to tax the trust. And then the trust company said, but hang on. So the beneficiaries did declare the tax on this. So this amounts to double tax, so that can't be. And then SARS said, I hear you, but those assessments for the individuals have all become prescribed. Right? Which is a valid defense. It is a valid defense. Of course, I found the solution to tell them how you get around prescription, but I'm certainly not going to tell everybody here what the solution is, right? There is a solution to it. But the point is you have to look at these distributions, one, to see if they are proper distributions, right? Is the resolutions there, or is it just people passing journals? Because, let's be honest, that's how lots of things happen. And then if so, is this loan effectively, is the trust continuing to use this money that was actually vested in a beneficiary as its own? It's a loan. If the trust keeps it in a, call it, as an agent on behalf of the beneficiary, so it ring fences the money, so I'm going to use this money that I vested in the beneficiary, I'm going to ring fence it and invest it and treat it and deal with it only for the benefit of that person, then the trust is acting with that money for the benefit only of that person. So it's not that person making the loan available to the trust in general, right? So then you could say, okay, fine, that loan probably doesn't fall into 7C. But for the most part, they fall into 7C. Then, of course, preference shares issued by companies owned by trusts, because people used to say, well, if I don't make a loan to the trust, because I know that loans to companies owned by trusts in certain circumstances fall into 7C, what is something that looks and smells like debt but is actually equity? Preference shares. That's especially redeemable preference shares, right? And so what people used to do is to say, well, an easy way to get around section 7C, I achieve the same point, I just don't call it a loan, and as opposed to loaning money to a company, I'll just subscribe for preference shares in the company. And then with effect from 1 January 2021, the legislator came and closed that loophole and said, no, those also fall into 7C, right? Those preference shares are deemed to be loans, effectively, that you subscribe for. There are some loans, of course, that fall outside of 7C, loans to the extent they are subject to transfer pricing. There's quite a history behind this exclusion, because I used to deal, and Vic, as you might recall, we used to deal a lot with foreign trusts, right? So you've got a shareholder, you've got a natural person in South Africa who has a trust offshore, or has a family trust offshore in Australia or the UK, whatever the case might be. And they are loans to this trust. And then people will say, but 7C is. No, it's not 7C. The guy's a beneficiary of a foreign trust. That falls into transfer pricing. And then we'll make the transfer pricing adjustment, because an arm's length interest rate for a cross-border loan to the UK is like 1%, right? Or 2%. So I'll gladly adjust for the 2%, which is going to be significantly less than 20% of the official rate of interest, right? I might be much better off. And then they clarified, or they amended the legislation, I can't remember, it said, the exclusion, because we used to argue, I want transfer pricing to apply. Because transfer pricing, if that principles apply, if those principles apply, it's cheaper than 7C. So it's a foreign trust, it's transfer pricing, no problem, 7C falls foul. Or we fall foul of 7C. No, they said to the extent that you make a transfer pricing adjustment. So if a market, so my interpretation of this is if a market-related interest rate is 1% and the official rate is 7%, then you're still going to sit with a 6% 7C problem. And the 1% will escape, because that's subject to transfer pricing. Does that make sense, Vickers? You also understand it like that? Yes. All right. Right. Certain employee share trusts, of course, don't. Bevins trusts, because the beneficiaries has the ownership of the assets, there can be no estate duty avoidance. Because in the case of Bevins trust, the assets already vest in the beneficiary, so there can be no estate duty avoidance. Loans to PBOs and small funding entities fall foul. Loans to special trusts. Special trusts are trusts to people who are disabled, or testamentary trusts for the benefit of minor children, only to the extent that the children are minor. Loans to acquire or improve primary residence of the lender or the lender's spouse, they fall foul, and loans to companies subject to dividends tax, right? So deemed dividends on interest-free loans. Those are all exclusions which you'll have to test. Now, I want to conclude with this, and then I can open up the floor for questions and debate. This is a structure that I've seen more than once before in my life, where I've been asked, is 7C applicable? Now, of course, every case depends on the facts, and one would have to look at the facts of every case, and I'm not saying this is a general rule. But when you look at this structure, where you have a trust that owns 100% of the shares in a company, and another trust, same beneficiaries, same trustees, that trust owns 100% of the shares in another company, right? Now company A has over the years made money, right? It's a business, it's running, it makes lots of profits, and it decides it's going to take some of that money, it's going to loan it to the company, the other company, because the other company is struggling or whatever the reason is. Does Section 7C apply? So we ask ourselves the question, fine. Where's the natural person, first of all? Because we know this is an estate duty thing and natural persons pay estate duty. So we know we have to go find the natural person here, right? And if it's a loan made by a company, it has to be a natural person that's connected to this company making the loan by virtue of paragraph D4 of the definition of connected person. And that says where the person alone or together with any connected person holds at least 20% of the equity shares. Where's the natural person here that holds any shares in what, let's say, company A, which is to the left of the screen? There is no natural person holding anything. Yes, he's a connected person to the trust, and that trust owns 100%, but the trust holds it alone. Right? So, and now the question is, let's check that conclusion against the basic premise of Section 7C. Is there estate duty avoidance? This company has made money it's made on its own, right? That would never have fallen into the estate, if you will, this money that it made on its own, which was in the company originally. It would not fall into anybody's estate, right? It is properly outside of estate duty, properly so. So why should this fall into 7C? I'm not saying use this as a general rule. I'm saying it's just an example of where 7C might not actually apply, despite it seemingly looking like it might apply, right?